Have you ever wondered what money really is? Is it cash, gold, or something else entirely? What if I told you that at its core, money is simply a ledger, a tool for keeping track of who owes what? This powerful insight comes from Broken Money by Lyn Alden, a deep dive into the history and future of financial systems. The implications might change how you see money forever. Money, as Alden explains, is not valuable because of its physical form. It is a shared belief, a social agreement. We trust that numbers in our bank account or on a screen can buy goods and services. But what happens when that trust falters? History shows that the moment trust is lost, entire economies can crumble. The form that money takes often determines who holds power. In early civilizations, commodity money like gold and silver was scarce by nature. Today's bank money, like dollars and euros, is controlled by governments and central banks. Whoever controls the ledger has the power to shape economies, distribute wealth, and influence global politics. Think about this. On the ancient Pacific island of Yap, people used giant stones called rai as money. They were not practical to move but symbolized wealth because they were rare and difficult to produce. Enter David O'Keefe, a savvy outsider who used advanced tools to quarry more stones and flood the market, disrupting the Yap Islanders' entire system of wealth. It is a prime example of how technology can upend financial systems and transfer power. Before we continue with more key insights from Broken Money, be sure to subscribe for deep dives into ideas that reshape how we understand business, success, and finance. Now, why is scarcity such a crucial part of what makes money valuable? Early forms of money like shells, beads, and even tobacco often failed because they were not scarce enough. When something can be easily produced, it quickly loses its value. For money to work, it has to be durable, scarce, and trusted. Without these traits, economies face inflation, instability, and collapse. This brings us to one of history's most trusted forms of money, gold. For centuries, gold reigned supreme because it was scarce, did not decay, and could be easily divided into smaller units. But even gold had problems. Rulers often cheated by mixing gold with cheaper metals to create more coins. While this trick temporarily enriched governments, it destroyed trust in the currency and caused economic breakdowns. Alden emphasizes that trust in the money system is always tied to who controls it, whether it is nature, governments, or modern institutions. With advancements in technology, societies eventually moved from gold to paper money. To understand how today's financial system works, you need to know the difference between two key concepts: base money and broad money. Base money includes physical currency like coins and bills and bank reserves stored at central banks. Think of this as the foundation of the system. Broad money, however, is mostly created through debt. When banks issue loans, they create new money out of thin air. This process is called fractional reserve banking. Banks only need to keep a small portion of deposits in reserve. The rest is lent out, creating a chain reaction of money multiplication. It is efficient but risky. Too many bad loans or sudden withdrawals can spark financial crises. The system is also far from fair. Wealthy individuals and corporations have easier access to credit and can borrow at lower interest rates. They benefit the most, while those with limited resources face greater financial struggles. As Alden points out, the gap between the rich and poor is often widened by the financial system itself. Here is where things get even more complex. In the 1970s, the global financial landscape shifted with the birth of the petrodollar system. After the collapse of the gold-backed Bretton Woods Agreement, oil, one of the world's most important commodities, was priced in US dollars. This created a permanent demand for dollars worldwide, giving the US immense economic power. However, it also made life difficult for developing countries that needed dollars to buy essential resources like oil. Many of these nations ended up in cycles of debt and financial instability. Now, enter Bitcoin, the digital currency that aims to revolutionize how money works by decentralizing control. Traditional money systems are managed by governments and banks, but Bitcoin operates on a distributed ledger called the blockchain. Instead of relying on a central authority, Bitcoin uses a system called proof of work, where computers solve complex problems to verify transactions. Those who solve these problems, known as miners, are rewarded with new Bitcoins. One of Bitcoin's most attractive features is its fixed supply. There will never be more than 21 million Bitcoins. This scarcity is why some people believe Bitcoin could serve as a long-term store of value, immune to the inflation that plagues traditional currencies. Think about it. Unlike central banks that can print more money at will, Bitcoin's supply is locked. But Bitcoin is not just about scarcity. It has real-world applications, especially in regions where financial systems are corrupt or restrictive. In one example, Roya Mahbub used Bitcoin to pay women in Afghanistan who were otherwise excluded from the banking system. Bitcoin allowed them to receive and manage money independently, bypassing traditional institutions. Of course, there are concerns too. Critics worry about Bitcoin being used for illegal activities. However, research shows that most Bitcoin transactions are legitimate. and improved regulation is reducing criminal use. Another major issue is environmental impact. Bitcoin mining consumes a lot of energy, but there are ongoing efforts to shift toward renewable energy and more efficient systems like proof of stake, which requires far less electricity. As technology reshapes money, new threats also emerge, particularly with central bank digital currencies. These digital currencies could give governments unprecedented control over people's financial lives. Imagine a future where authorities could freeze your money or monitor every transaction you make. Alden warns that this erosion of privacy is a critical issue in the digital age. Before we discuss the future of money, take a moment to subscribe so you never miss insights like these. So where does this leave us? We are standing at a crossroads. One path leads to greater decentralization and financial empowerment through technologies like Bitcoin. The other path leads to more centralized control and surveillance. The choice we make could shape the future of money and society for generations to come. Before you click on our next video, consider this. In a world where money shapes power, who do you trust to control the future of your wealth?